My name is Zap, and this is going to be Venture Capital for Dummies. I want to preface this by saying that you're not a dummy, I'm a dummy, and that's why this is for dummies, is because I'm explaining things in the most easy to understand way possible from my own perspective. And maybe you find it helpful, hopefully, fingers crossed. Anyways, let's get into it. What is venture capital? First of all, it's an investment. So we can think about, when you invest in things, most people think about investing into stocks and bonds, which is going to be the public market. Something like venture capital is going to be in the private market. So similar with any private equity deal or hedge fund deal, it cannot be, the information is not just found publicly available online. It's not as regulated because it's a private investment, but there's a lot more risk associated with it. How does a venture fund even start? Well, really it all has to start by there being a general partner. This is a person, let's see what I wrote. Someone that has the balls to raise money to invest in emerging companies for equity. Yes, someone is out there who is really taking the risk by saying, hey, give me your money. I'm so smart that I'm going to go invest this money and make more money and give it back to you. It has to be a really ballsy person to be a GP of a fund and start your own fund. But the people who run venture capital, or these venture capital funds, they're going to be called GPs, general partners. When you start a fund, you're probably going to have to come up with an investment thesis. What is an investment thesis? It's essentially your plan on how you're going to make yourself and everybody else some cash money. Typically, the general partner is going to people and saying, like, give me your money. I'm an expert investor. Like, I'm going to be so good at this and make you more money, and kind of explain to you why they're the experts, why you should trust them with their money. Their investment thesis typically is going to be around either something industry-wise, so let's say they're an expert in the fintech industry, the prop tech industry, climate tech industry, or it's going to be something about stage. So they're going to be either investing in the earliest baby companies or companies that are maybe in more of a growth mode, or it could be both of those. Or it could be something really unique where they just invest in whatever, but that's pretty atypical. A venture fund is and sometimes they have even more narrow. So it might be yes, there's funds out there who invest in fintech, but it's more likely that they invest in fintech at a series or at a pre-seed stage, or maybe they invest in a subset of fintech. Maybe it's payments at a pre-seed stage. Usually people nowadays get pretty niche because it's their job to be the expert. They have to be really good at investing into whatever this space or stage is. And then they're trying to make money by investing into these companies for equity. So when I say equity, it means that, hey, you can just think about Shark Tank is actually taught us all what equity is all about. I'm going to give you, $1 million in exchange for 20% of your company, and the goal that the company is going to only make more money, and so your 20% will be worth more than the $1 million you invested in at the beginning. But they don't really make any money. It's all paper money, pretend money. The company might be worth more, but no one gets paid until the company they invested in is either 1, acquired, or 2, goes public through an IPO, which is significantly less common, but people always think about it. Anyways, who actually invests in venture capital? Typically, it's only accredited investors who invest in venture capital. What is an accredited investor? It's going to be someone who either has made an income of $200K in the past 2 years, $300K with someone else, a net worth of $1 million, organizations with $5 million in assets, or anyone who has any of these passed these finance exams. So we call these people who invest in venture capital LPs, so limited partners. Really, the GP is very responsible to the LPs, because even though they tend to put in a good chunk of their own money to be a GP, the majority of the money is going to be coming from other people, aka these LPs. Who are they? Honestly, they're people with lots of money, like straight up. What does that mean? It's either going to be high net worth individuals, a family office, which means like you're so rich that like you have a whole team that manages your money, endowments, or pensions. But I think most people just think about, honestly, like high net worth individuals and family offices when it comes to venture. And so you might already start getting confused of like wondering, what is venture versus private equity? Really, venture is a type of private equity, but it's just a little bit different. They typically do, I just paint the picture here. They do smaller investments in lots of companies. They make the bets very early. They're kind of not as involved in the business because they just invest in so many. They can't be involved in all of them on a day-to-day basis. It's technically a little bit higher risk, and they make money because these companies, they need to grow, they need to scale. They're baby companies that need to grow up and get bigger. While in private equity, typically they make fewer investments, but they're significantly larger. They're really investing once a company is already making lots of money. They just come in, and typically they like take control and like usually they see like a market opportunity to like make that company better. And it's known as less risky because the company's already like making money, like you're investing in something that makes money, hoping it'll make more. Venture, you're investing in something that might make no money, hoping it one day does, type of thing. And PE typically goes in and like gets very involved in the company and like can take over and running it, while in venture, like when you invest, you're gonna let, you want to trust the founding team to run the show a little bit more. How do VCs actually make money? So the GPs, again, go out and they go raise money from these LPs and say, trust me, give me your money, I'm going to make money with it, and we're all going to win. So they typically have to put in a little bit more of their own cash. So that's why a lot of GPs already have achieved some level of wealth to be able to start their own fund. But they make money by what's called in the industry the 2-and-20 split. Not every venture fund does this, but this is kind of like industry standard. So they take a 2% management fee. What that means is any money that someone invests in the fund, like 2% is just sliced right off the top. And that goes to like salaries, fund operating expenses, so things like lawyers and technology and travel and stuff like that. And that 2% management fee, most funds have like a life cycle of people commit to giving you money across 4 years. So each year they take that 2% cut to pay for the fund. And so you have to raise a good amount of money. If you do some math in your head and think about it, you have to raise a good amount of money to actually get paid from the 2%. But the big money is hopefully in what's called the carried interest. So the GP takes 20% of a carried interest. What that means is, like, whenever a company sells and makes money, the fund and the GP, they take their 20%. That's their payday. And the other 80% goes back to the investors who they took money from. And so let's say if a company sells for $100 million, well, that's a great payday for it could be if, let's say, they invested for way less. They're going to take that 20 million back, and then that 80 million goes back to the investors, but that's where they make their big money. They're trying to sell these companies to make money, and it takes a long time to make money in venture. It is not just like put money in, then you're going to get money back. It's going to take 8 to 12 years. Before then, there's a lot of what I call like paper money. So these companies are worth more on paper because other people have invested, their valuation is more, yes, they're making more money, but no one really gets paid and gets their money back till the company sells or goes public. Okay, how it's measured. This part is not for dummies, so I'm not really going to get into it because I am not a math teacher, and I had to watch a shit ton of YouTube videos to learn about this myself. But when LPs are like looking at a fund, trying to sell the fund, so get people to invest in it, they're going to want to have they're sharing their IRR, the internal rate of return, which is pretty much like how much money you're making versus time, or the equity multiple of like, okay, you put in, like, well, the example is here. If you invested $10,000 and you made 100K, your equity multiple is going to be 10. They want to get those numbers high. And so then they can go convince people to give them more money. The better they do, the more money people give them. Okay, so let's say someone raised money, like, now what do they do? I mean, that's the first step in starting a venture fund. And even if you don't want to start a venture fund, I think it's good to understand, like, why do venture funds exist? We're taking other people's money and trying to make more money with it. I think that's probably the biggest misconception in venture, and it sounds silly, but so many people are like, I'm just really excited to like help founders and like work with companies, and you totally can do that, but the bottom line is you are trying to make money for your LPs, and you have got to deliver, or else you will be out of a job by essentially no one giving you more money. So once you raise the money, what do? Industry term, deploying the capital, aka you got to spend the money that they gave you. You got to invest it in stuff. Okay, so how do you deploy that capital? Well, it's probably going to start with another industry term called deal sourcing, which I think is such a funny term. People are like so into their deals and who has the best deal flow and how good your deal flow is. But all that means is, like, are you really good at finding a bunch of companies? And it's a little bit of a quantity thing, but it's also this quality of like actually finding good companies that have like a good shot at making money again. So how does one do deal sourcing? This is my very simple explanation, but typically you're an expert in whatever you're investing in. You're like super clued in. You're like the go-to person in a type of way. You're going to events. You probably have a bunch of friends who share deals with you. So those friends could be other funds investing. They could be, I don't know, accelerators or incubators, or maybe your LPs themselves share with you good deals. But people act like it's like a secret sauce. But you just go and you find a bunch of companies. And then you can also just reach out directly to founders. But also most people just get a lot of inbound leads of founders trying to raise money from them. I like this slide a lot that I made. VC math. You're going to talk to like 100 companies and maybe invest in like one of those companies, and like maybe like that company has like a 1 in 10 chance of like actually making money. So that is what I think is like the super hard part about venture, that everyone kind of acts like if you're in it, you kind of have to act like, oh, like I've got the secret sauce, like I know the answer to it. But the answer is not always clear. You just have to talk to a shit ton of companies and be able to quickly figure out like who has a chance at actually winning and making you money back. And you're going to talk to a lot before any of them make money. You can get into more complicated VC math, but I think mine's pretty darn good. Okay, next is, let's say you find a great deal. You're like, I think this company is going to crush it and they're going to make us so much money. Well, then you send them through what is called the due diligence process, is the industry term. What that means is this company going to make money? Actually, let's like do some research. And are they legit? Like, should we give them our money? Are they real? And so in the due diligence process, I'm not going to get into the weeds, but you're pretty much looking at these main categories. So like, you want to make sure their financials are in order. You know, they told you that they're making this much money and they pay these people this much, and then they're going to like spend your money on X, Y, and Z, but you should probably like look at their books and make sure that's all true. And legal, you know, they probably have contracts with the people they're working with. You want to make sure those contracts are good. That you want to make sure they are like in good legal standing as a business, I guess, and registered correctly. You want to look at the market. Are there a ton of competitors in this space? Is it crowded? How is this company so different that they're going to make money and be like the winner or the best, or at least have enough of the market that they do make money? You're going to want to look at the product. Like, is their technology actually working? Like, can it continue working into the future? How could it be better, type of thing? You're gonna want to work. I don't know what I'm saying here. You're gonna want to look at the business model. Pretty much, like, there's a lot of stuff you can do in the due diligence, but like overall, and then you want to just talk to the founder and team too. Like, you're giving this person money. Do you actually trust them to build this company they say they're going to build? And even if they, like, it doesn't work, you kind of want to know that you gave your money to someone you really like believed in and was a good person and like tried their best and hardest to like make things work and is smart. But all in all, I feel like people really complicate the due diligence process. Like, I know that there's a lot that goes into it, but to understand it is like you just always have to just think about, is this company going to make money and are they legit? Like, is kind of my For Dummies overview. Okay, now let's say you invest in the company, you've done a deal, and I could do a whole talk about that for dummies, but in this one we're going to skip to, now your job managing this fund is you're going to do what's called managing the portfolio, aka this shit better work. These companies better make money. What does that look like? Well, it's likely that you took a seat on the board, so you have a pretty active role in the company and knowing what's going on. You can do things like helping them hire. You help them think about stuff. So maybe about new products to add, maybe about the challenges they're facing. Whatever sort of comes up, you're kind of like there, you know, you kind of call, they want to be able to call you and like get your advice. And that's why VCs are usually like experienced entrepreneurs or like are really good at helping companies grow because they just know what to say. You want to help them get more customers and like make money. You want to help them maybe raise more money. Like, if you could invest more money, but you also want to be like, hey, I'm not going to invest. Like, if you're not going to invest, you better have some connections to be like, well, I have some friends who might be able to invest in you at your later stages too, type of thing. This is where like venture funds need to oftentimes differentiate themselves, because let's say it's a super good deal, like the founder of that company is going to want to go with who's going to help them, because they want to make money too. They want to go with, okay, let's say I have 3 venture funds trying to invest in me. Well, I want to work with the one who's going to like help me the most, probably. You know what I mean? And you can help them all these different ways. Some funds suck at all of these. Some of them are probably great at all of them. Some of them are maybe really, really good about one part and not as good about the others, type of thing. All right. Another role is investor relations. In this role, you just want to let your investors know that, you know, everything is chill. Their money is making money. Just, you know, be patient. Remember, we told you guys it's going to take a long time for us to make money at the beginning. We told you it was going to be 8 to 12 years. We promise we're going to make you money still. Here's like what the companies are doing. Please like love us and keep giving us your money. Maybe you could help us a little bit. Like, maybe one of your investors, like, you need their expertise in something. Maybe not. Or give us more money. Hey, thank you for investing in our last fund. We're raising money for our next fund. You should give us more money for that. Like, we'll make you more money again. That's kind of what investor relations does in a nutshell. Another role within the fund that you have to do is fund operations, aka just actually keeping the business running. I'm super bad at this part, and I feel like this part is often forgot about, but someone needs to be there to just manage systems and processes of, like, you know, we're talking to hundreds of founders a week. How do we know who we're talking to? How are we tracking that? Like, could we do it better? Like, I don't know, we need to have a website. That website should be good and working. They do taxes and work with lawyers on legal stuff and reporting and just other general admin stuff, probably like payroll, paying employees and things like that. There could be a lot of roles within fund operations too. So as like a recap, if you want to go work in venture, a lot of people, and this is a common misconception, so many people have all these ideas of what they could go do at a venture fund, but it's probably going to boil down to like you're going to be doing one of these things. You're either going to be raising money, finding deals, making sure those deals are good deals, helping companies do better, just keeping the business running. And then nowadays there's some funds who might have a hire to just focused on like marketing the fund or like events for the fund, but it really boils down to these simple things. And so how do you break into venture? This is the line I hear all the time. How do you break into VC? Well, very simply put, you probably want to be really good at one of these things. It'd be better if you were good at multiple of these things, but you better be good at least one of them. And it also helps if you know somebody. Helps a lot. So you get two options. But why it's so difficult to break into VC is it's very simple. I feel like people overcomplicate it. There's just like not many jobs. There's not that many venture funds out there in the world, and they're typically not hiring very frequently. These companies tend to be very tiny. So, you know, this 5-person company probably isn't doing a big nationwide search to make their hire. They're typically probably hiring from within their network. If they were kind of well networked and good at their jobs, they probably know who the right person for the job is. And again, they probably want to hire someone who is already good at something. And it'd be better if you've already done it, but there is some ways that you could at least like learn about this stuff not in venture. Like if you raised money for your own startup or like had a network of wealthy people, if you just are really good at sourcing deals for maybe a startup incubator, or like for me, like I kind of do it on my own sort of thing. If you're just such an expert, but again, this is oftentimes you've already built a company in this space, maybe you're so like in the loop, embedded in the industry, to be able to like making sure the deals are good, help the companies do better type of thing. I think one of the easiest ways to kind of get in is probably just being like a finance role, or just being very operationally driven or good at marketing typically. Anyways, that is the end of Venture for Dummies. I hope this was helpful and you learned something. Please do not cancel me. I just want to explain things in a really fun and approachable way so people realize that all these finance bros just put words around stuff and it makes you feel like it could be really confusing. And it's hard, but it really shouldn't be confusing. It should be simple. So thanks for tuning in.